China has become a powerhouse, a nation that rose from poverty to become the second largest economy in the world. Its factories, cities, and people have transformed not only China but the global economy as well. But beneath this impressive growth lies a complex web of challenges that are beginning to show cracks. Today, we're exploring China's economic crisis, its implications, and why what's happening in China is a warning for the world. Let's dive deep into the heart of the issues shaping this complex situation. China's story is one of astounding growth. For decades, the country maintained double-digit GDP growth, expanding its economy at a pace that seemed unstoppable. From the late 1970s onward, China's economy averaged around 10% annual growth, largely driven by heavy industry, manufacturing, and exports. This rapid growth lifted hundreds of millions out of poverty, creating a new middle class and fueling urbanization on a massive scale. However, since the mid-2010s, this engine of growth has slowed dramatically. Now, China's growth rate sits around 5%, far from its former highs. For most countries, this would be decent, but for China, it signals something serious. China's growth has been the lifeline that sustains both the country's economy and social stability. When growth slows, it affects everything, from employment to income to the government's ability to maintain public services and infrastructure. This slower growth isn't just a statistical change. It's a sign that China's economic model, built on investment and exports, is running out of steam. And as we'll see, this slowdown ties directly into a web of interconnected problems. One of the most visible signs of China's slowdown can be seen in its real estate market. Real estate has been a major growth engine for the Chinese economy. The government promoted massive construction projects, new cities, and housing developments as a way to drive economic activity and wealth creation. Real estate quickly became one of the most popular investments for Chinese families, and it now accounts for almost 30% of the country's GDP. But this growth was built on risky foundations. Developers borrowed heavily to finance ambitious projects, and the market became oversaturated. Today, there are entire cities full of empty apartments, ghost cities where no one lives. Major developers like Evergrande took on immense debts that they now can't repay, creating a crisis that threatens China's financial stability. Evergrande alone owes billions, and other property giants are in similar positions. If these companies go under, it won't just hurt their employees and investors. It could send shockwaves through China's financial system, impacting banks, lenders, and the millions of Chinese people who bought homes in these developments, expecting them to grow in value. The real estate market crisis has become a vicious cycle. As property values fall, people feel poorer and spend less. This reduces demand for goods and services, which hurts businesses, slows the economy further, and creates a drag on growth that affects nearly every sector. For China's economy, the collapse of this real estate bubble is a threat that could take years to overcome. Another issue weighing on China's economy is youth unemployment. In recent years, China has seen a surge in unemployment among young people. In 2023, youth unemployment soared past 20%, according to official statistics, though some believe the real figure could be even higher. For a generation that has grown up with the promise of prosperity, this job crisis is a bitter reality. China's universities produce millions of graduates each year, but the job market isn't providing enough opportunities for them. Many young people are underemployed, taking jobs below their skill level, or struggling to find stable employment altogether. This issue has long-term consequences, as it limits their ability to save, invest, or buy homes. Essentially, it restricts them from participating fully in the economy. High youth unemployment doesn't just impact the economy, it also poses a social risk. Young people who feel that they have no opportunities may grow disillusioned, leading to frustration and even questioning the government's leadership. For a society as tightly controlled as China, this discontent is a significant risk, one that could create pressure for change. In many ways, China's youth unemployment crisis is a ticking time bomb that will have consequences not just for today's economy, but for China's future. China's one-child policy, implemented in the 1980s, was aimed at controlling population growth, but it has now created a demographic crisis that China's leaders are struggling to address. Today, China has an aging population and a shrinking workforce. Birth rates have fallen to historic lows, even though the government has lifted restrictions and now encourages families to have more children. An aging population means fewer people in the workforce to drive economic growth and support the older generation. This creates pressure on China's social services, healthcare system, and pension funds, all of which will require greater resources as the population ages. An aging population also means lower productivity, as there are fewer young people entering the labor force. In other words, China's demographic time bomb could lead to a situation where there are too few workers to sustain economic growth and too many retirees in need of support. This demographic shift is a severe challenge for China. Japan faced a similar situation, leading to decades of economic stagnation. But for China, the stakes are even higher. Without enough young workers to maintain the economy's growth, China could face significant obstacles in the coming years, and the effects of its aging population will be felt for decades to come. China's economic success has been largely built on exports, with its factories supplying goods to countries around the world. However, rising trade tensions, especially with the United States, have disrupted China's access to global markets. Tariffs, trade barriers, and restrictions on Chinese companies have created a challenging environment for China's export-based economy. In addition, the COVID-19 pandemic accelerated a shift in global supply chains, with countries and companies looking to reduce their dependence on China. China's role as the factory of the world is under threat as manufacturers diversify their supply chains, moving production to countries like Vietnam, India, and Indonesia. This shift could erode China's manufacturing dominance, reducing its influence in the global economy. If China loses its position as the go-to source for manufacturing, it will lose a crucial source of revenue, jobs, and influence. Furthermore, as trade tensions rise, so do concerns about technological rivalry, particularly in sectors like telecommunications, semiconductors, and artificial intelligence. China has been pushing to develop its own advanced technologies, but restrictions on technology exports from countries like the US have slowed its progress. Losing access to critical technology could hinder China's goal of becoming a global leader in innovation and high-tech industries. China's growth has largely been fueled by debt. Local governments, state-owned enterprises, and private companies have borrowed heavily to fund construction projects, infrastructure, and development. Currently, China's debt-to-GDP ratio exceeds 300%, raising concerns about the sustainability of its economic model. High debt levels become especially dangerous during an economic slowdown. If companies and local governments are unable to repay their debts, this could trigger a wave of defaults that would shake the financial system. China's banks, many of which are state-owned, are heavily exposed to this debt. If major borrowers default, it could create a crisis within the banking sector, potentially requiring government intervention. In recent years, China has been trying to reduce its debt, but progress has been slow. The government is caught in a bind. If it reduces spending to lower debt, it risks slowing the economy further. But if it continues to allow debt to grow, it risks creating a bubble that could burst, leading to a financial crisis. The choices China makes on this issue will have long-lasting consequences for its economy and could even affect global financial stability. Each of these economic issues affects China's people, and together they are creating a wave of frustration and uncertainty. Rising costs, limited job opportunities, and the pressure of supporting an aging population are creating stress for many families. This discontent is a serious concern for the Chinese government, which has long justified its authority through economic success. If China's economy continues to struggle, the government's legitimacy could come under question. For decades, the government has maintained a social contract with the people. In exchange for limited political freedoms, the government provides stability and growth. But if that growth stalls, this contract may weaken, leading to social unrest or demands for change. This social dimension of China's economic crisis is perhaps the most unpredictable element. Economic issues can be managed, but widespread discontent is harder to control. As China faces these challenges, the government's response will be closely watched, both within China and around the world. What happens in China doesn't stay in China. As the world's second-largest economy, China's slowdown affects global trade, commodity prices, and financial markets. A weaker China could mean lower demand for resources, impacting countries that rely on exporting goods like oil, metals, and food to China. Lower demand from China could also lead to lower prices for these commodities, affecting industries and economies worldwide. Furthermore, China's role in global supply chains means that its struggles will directly impact manufacturing, shipping, and trade around the globe. So while the issues China faces may seem far away, they have implications for all of us. Thank you for watching.